Were there any questions about what we talked about so far, specifically how to read a stock chart?
No.
No questions? It all makes sense so far?
So far.
Excellent. So I guess the next question we want to ask is, how do you know which stock to pick so when you're going to make that decision? Okay. My first piece of advice there is to buy what you know. I remember when Facebook was having their IPO and they were coming out, I think their stock price, opening bid price was $45, what they were coming out at, $45. And I talked to my dad, and my dad said, what do you think about Facebook? And do you think I should buy it? And at that time, and even I guess now, I don't have a Facebook account. Didn't know anything about Facebook. And I said, Dad, I don't buy that I don't know. So I don't understand how they make money. So I wouldn't recommend buying that stock. And they came out at $40, and within 6 months, they were down to like $20. So I have to call my dad and be like, hey, see what I'm saying? I'm a genius. Just listen to me. But now I don't even talk to my dad anymore because, no, I'm just kidding. But obviously they've recovered. But it's still, right, when you're investing, I'm not investing as a gamble, right? I'm investing in products that I believe in. And Facebook, I mean, I understand it now. At the time I didn't understand it, so I wouldn't have bought into that, right? And it was obviously I would have made money if I had bought it at $40. The other thing you want to consider is the current price and the valuation. Okay? Remember, if they have a price to earnings ratio of less than 15, that's considered a really good buy. If it's greater than 20, it's considered expensive. But in today's environment, where the stock market is still overvalued compared to earnings, and as the new earnings, yesterday, Ford came out. Today, my watch is blowing up. There's a bunch of other companies releasing earnings today. Earnings are going to be significantly down, right? Which is going to make that P/E ratio become even bigger, right? Because we're not going to see significant drops in the stock price to kind of match what their earnings were. So this 20 being considered expensive, it's just an expensive market to buy in, right? So you can't just, so I'm not suggesting that you try and time the market and wait for everything to be below 20 before you start buying again. But as you're choosing between stocks, you can compare the price to earnings ratio of one company versus another. And then you also want to make sure that you have a sense of how well the company's doing. What's their financial health? And I'm not talking here about speculation, thinking about what's going to be the next big thing, but just looking at that company right now. How much cash do they have on hand? What's their cash burn rate? What's their gross margin? I don't want to say gross margin, profit margin. How much are they earning for every dollar of sales they generate? How much are they keeping as income, right? So these types of questions that you want to consider when making a decision. Are there any questions?
For the last one, for the financial health, do you have any suggestions as far as where to go to get that kind of information?
I do.
Google?
I do. Yeah, Google is always the best place to go. But you can also go to the SEC Securities and Exchange website.
Oh, okay.
www.sec.gov. I just typed it in the chat, and they have the financial filings for all of the for all publicly traded companies or companies that have publicly traded stock.
Oh, okay. I didn't know that.
What you also could do is if you go to like a specific company, you can go to apple.com and click on their, you'd have to find it because apple.com is a store, but you can click on their investor relations section, and then you can also find the SEC filings there.
Okay, right on. Thank
Which
you.
leads me to my, yeah, you're welcome. Are there other questions?
I have a question, Professor. If the companies own a lot of cash, is that to me its financial health is good?
If they have a lot of cash?
Yeah.
Well, we can't evaluate financial health just based off of one metric.
Okay.
But I would generally say that if they have a lot of cash, that is considered a good thing, because that means they're putting themselves in a position to either make an acquisition of another company, expand their business. They could buy back shares from their shareholders, you know, at a premium price, so you can purchase, you know, they could pay out dividends, right? So there's a lot of things you can do with cash. I think other things to consider would be like when you're looking at their revenues, how much money are they making? Are we seeing a trend of going up or a trend going down? Right? If you're seeing a downward trend, that's an indication that, you know, this company may not have the sustaining power to move in this new environment. Take, for example, I don't want to be too well. We can take, for example, Circuit City, right, or Good Guys. Those were electronic stores, big box electronic stores, where you would see their revenue starting to decline as big box stores like Target, Walmart, Costco said, hey, we can sell electronics and we can sell groceries and we can sell household supplies and we can sell gardening, right? And so people say, well, wait a second, why am I jumping from the hardware store to the electronics store to the grocery store when I could just go into Target or Walmart and get everything that I need, right? And so that revenue declining may also be an indicator.
Okay. Thank you.
You're welcome. Are there other questions? So speaking about, I'm going to move on with financial health. The question we should ask ourselves is, how do you know if the data, the financial data that you're looking at is reliable? Right? And so you want to make sure that we're looking at what are called audited financial statements. Audited is just a fancy word for it was checked. Someone checked it. Someone who did not prepare the financial statements checked it. So every publicly traded company is required to submit audited financial statements on an annual basis. So every year they have to have an accountant or an accounting firm who's not part of the company, an independent accountant, come into their company and check, make sure that their financial statements are correct. I'll say that for the most part. Let's just say they're correct for the most part. In addition to that, right, and so you can find that those audited financial statements at www.sec.gov. In addition to that, every 3 months, every quarter, fiscal quarter, the companies have to provide updated financial statements. These are not audited, but those same independent accountants are also going to go through and look at those financial statements as well and make sure that they are not incorrect. I think is a good way to put that. And so you can also find those on the www.sec.gov website. The audited financial statements, I'll just type it in the chat, are called the 10K. The quarterly financial statements are called the 10Q. The 10K is a lot bigger, right? That 10K report is, I don't know, they're usually like 170 pages. The 10Q is going to be shorter, say it's like 80 pages, 70, 60 pages, something like that. But they're giving you updates every 90 days, every quarter. But just having those financial statements in your hand are not helpful. So here's my other advice, is that you should take an accounting class. Okay? If you are serious about understanding or getting into the stock market, you should want to understand how accounting works. And don't just take any accounting class. Take my accounting class, because the way I teach, we're talking about using accounting as the language of business. So we're talking about ratios. We're talking about not just how the financial statements are prepared, but what are the financial statements going to tell you once they are prepared. Okay? You want to understand that. And don't just take it from me. Actually, I'll pause there and see if you guys have any questions while I try and find this video. What questions do you have?
Does an accounting class help with a business major or minor?
Yes, if you're majoring in business, then you have to take an accounting class.
Oh, okay. Good to know.
And you can take the accounting class here. We have Business 1. That's our financial accounting class. A couple people here have taken that class with me. And that class will count toward your major for business. So, guys, I'm just I'm just giving you my own opinion, but let's hear from someone else who also has an opinion on this. This is Warren Buffett. Can you hear it?
Yeah, not really.
Oh, you cannot hear it?
No.
It's quiet.
It's slow.
All right. Well,
Yeah, not so much.
All right. Thank you. Let me try do this way.
Could you put the word on the screen?
Please allow. Okay, let me try this way. Stop share. And I'm going to join with my computer audio, see if that helps.
Can you all hear me?
Yes.
All right, so let's see if it's going to work now with computer audio.
If you turn on subtitles, it's helpful for me.
You got it.
Yeah, thank you.
I learned here, but I learned a lot. But the most valuable was accounting, and we had a wonderful
Much
professor,
better.
Ray Dean. There may even be something named for him down here, isn't there? Yeah, I mean, he was. I'd been to the Wharton School. I went to Columbia Graduate School subsequently, and I took a lot of accounting courses. But by far the best instruction I received in accounting came from Ray Dean, and there's nothing more important. People ask me what they should take in business school, or even if they don't go to business school, what they need to know before getting in business. And I tell them, you have to understand accounting. It's the language. I mean, it's like being in a foreign country without knowing the language if you're in business and you don't understand accounting. So you want to get as comfortable with that as you are with the English language. It's made me a lot of money because I listened to what Ray Dean had to say 53 or 4 years ago, and have been able to understand what I was seeing on pieces of paper, what that told me about businesses, and the limitations of what it told me about businesses. I mean, but that's the way we invest. Yesterday, I was in Knoxville, Tennessee, and we bought a company. We agreed to buy a company called Clayton Homes about a week ago. It's a big company in the manufactured home business. We agreed to pay $1.7 billion for it. I made that deal over the phone without ever meeting the people there, but I had seen enough through reading 10Ks, 10Qs, annual reports, but looking at figures, what they tell me in terms of the kind of people even running the place, the kind of accounting decisions they make and so on. I was able to make that $1.7 billion transactions over the phone. Yesterday was the first time I met the people, and their board of directors had actually approved the deal a week earlier. So it's, I couldn't have done that if I hadn't have, I had a great time at Ray Dean's class 53 years ago. So if I'm going to tout one thing, aside from this particular leadership class, of course, if I'm going to tout one thing, I would tell you that get comfortable with it. It may not happen the first week or the first month in the class, but get very comfortable with accounting. So that I run into CEOs periodically who really don't understand it. And they try to bluff their way through, and you can see in their faces, they're frightened almost when somebody hands them a balance sheet or an income statement. They really don't know what it means, and they have to count on somebody else. And that's something you shouldn't count on. We make all our acquisition decisions ourselves. I mean, we don't call in consultants or anybody. We don't call in investment bankers, much to their disgust. No investment banking fees in the Clayton Homes deal, because it's my responsibility running Berkshire to understand enough about our acquisition decisions to make them based on the numbers that I see and what I see there.
All right. Well, you heard it from Warren Buffett, who is one of the richest people in the world, and he made his money through investing. Can you all hear me well? I've seen someone saying that it's lagging. I don't know if you're just referring to the video.
Yeah, they were referring to the video. We can hear you.
Yeah, we can hear you fine.
Okay. If it gets choppy, let me know. I'll jump back on the phone. All right. So let's. Any questions or comments about that?
No, he seemed to be pretty straightforward. He had a consistent saying, get familiar with accounting. Get
Learn the
familiar.
language.
Learn the language, that's right.
Yeah, learn the language. All right, so let's get to some of the questions you all asked on Monday. One question was, how do you start investing in S&P 500? So you've heard me talk about this a lot. And right now we're talking about investing in individual stocks. And we're going to, next week, talk about mutual funds. And so it's important to know that the S&P 500 is a index fund. It's a mutual fund. You can't invest in all 500 companies individually. What you're investing in is the track record of all those 500 companies. And to invest in them, someone's saying they can't hear, it's breaking up. I'm just going to go back to my phone.
I can hear you.
Oh, am I doing okay?
Yeah.
I can hear.
All right. So if you wanted to invest in the S&P 500, you would just go and open up an account at any one of these, Vanguard, Fidelity, Schwab, iShares, T. Rowe Price. All of these guys are offering index funds in the S&P 500. The specific one that you choose should be based off of kind of where your comfort zone is, right? If you already, or where you're already banking. So if you already have a Vanguard account through your 401k or your individual retirement account, invest through Vanguard. If you're already banking at, if there's a Fidelity near your house and you see the office, and go with Fidelity, right? If you like Charles Schwab, go with Charles Schwab, right? So they're all going to kind of result in the same. The only difference is going to be how much it costs to start investing. It could be anywhere from 500 to 1,000 or more, and it also can vary in what they're charging you in terms of fees. Okay. Questions? And so
yeah, what
Willie's question is, I just answered it, minimum investment. And so to find out the minimum investment, just go to Google, type in Vanguard 500 index, minimum investment, and you'll see what their minimum investment is. You're going to ask a question, Bryant?
Yeah, but I wanted to know, I guess, besides the minimum investment, what are some of the differences between these different index funds?
There's not a significant difference between these. The only difference is going to be how much you can start with, and how much they're charging you per on an annual basis to invest with them. But I would imagine that all of these are going to be similar in terms of fees, because you're almost buying a commodity, because they're all tracking the same 500 companies. All right, there was a group that had that question, so hopefully you're all satisfied with that. I'm gonna take that as a yes. So another group asked the question, how many years of financial performance should you look at when you're evaluating a financial advisor? And the general rule is 10 years. So you want to ask this person for 10 years of data that's auditable, right? I'm not saying you have to audit it, but it has to be data that can get traced back to some sources to prove that this person has a track record. And what you want to see is that this person has, over the 10-year period, at least for me, has done better. You got to do better than the S&P 500, because I can invest in the S&P 500 myself. So you got to do better than the S&P 500, and I want to see some consistency. So 10 years is what the average is. There's other things that you want to consider, though, beyond that. You want to find out if this person is a fiduciary. Okay? So what a fiduciary is when they make an investment, give you investment advice, an investment suggestion, they're taking on legal responsibility for that. And it's not saying that if we lose money, you can sue me. That's not what they're saying. But they're saying if you've invested in something and I didn't disclose all the information, all of my relationships, all the fees, then you have a right to sue me. Okay? So you want to make sure that this person is a fiduciary agent. The other thing is you want to make sure that you have a clear understanding of how much are they charging you and how do they charge you. It should be really straightforward. Again, going back to keep it super simple. If you can't explain this to your mom or to your grandmother, to your husband or your wife or someone that you love, that you can't sit down and explain this, someone that you know very well, you can't explain it to them, then this is probably something you don't want to get involved in. You also want to know that person's background, and make sure you have a sense of, where do they have their certifications, their series 7 license. Did they go to school? It's not necessarily, I don't think you necessarily have to go to college in order to become a financial advisor. But did they go to college? What's their background? Where have they worked before? And then the final thing is, actually, does anybody know who this is?
Mm-mm.
See if someone's going to type that in the chat.
Is that Bernie Madoff?
That is. Someone said he's in jail. Yeah, that's Bernie Madoff. He's in jail. Trust. Above all these things, you want to make sure that you're working with someone that you trust. Now, it took me a while to find this picture because I typed in Bernie Madoff and like all the images were him being arrested. And I'm like, no, Bernie Madoff was really, really good at what he did. So you've never heard the term before, Bernie Madoff was responsible for the largest Ponzi scheme, pyramid scheme, where he was getting investors, telling them they were investing in something, and but basically not investing the money, just using the money that some people gave him to pay off other investors in interest and dividends and things like that. And it was the largest Ponzi scheme ever. Yes, he is in jail for the rest of his life. But he was a very trustworthy person, and he looked very trustworthy in this picture. So above the years of performance, if it's someone, you want to make sure that it's someone that you trust, someone that where you're getting a recommendation from a family member that you respect and that you trust, someone or someone else that you respect and trust. Questions? So another question is, how much do you need to consult a broker? Okay. So if you're talking about a stockbroker, okay, on average, you need about $250,000 in invested assets. Okay. So that can be in the form of cash, mutual funds, in your retirement accounts. But a stockbroker can be an individual, or it can even be a firm. Like E-Trade is a stockbroker, right? And you just say, I'm working with E-Trade, and they'll assign a specific person to you. But they're only going to work with people that have about $250,000 or more in invested asset, because they make their money based on a percentage of your invested assets. Okay? And so if you're just investing $5,000 and they're making 1% of 5,000 on an annual basis, 5,000 times 0.01, that's $50 a year that they're making off of you, versus if they go to someone who's got 250,000, 0.01, that's $2,500, right? So they're going to focus, even if you do have a broker and you don't have a lot of money in invested assets, you're not going to get, just realistically speaking, you're not going to get their attention, right, compared to others who have more money invested. But a stockbroker is not the only way to buy stocks. Okay? I don't know if you guys have heard of this term. If you haven't, you should Google it. But this is called robo-advisors. Okay, so this is, I want to say, relatively new. It's about a little over 10 years old. And what these robo-advisors is, it's basically a computer that's acting as your stockbroker. And it's based off of algorithms and data, right? And they're saying, based off of your age, based off of your goals, based off of the historical market, this is what you should be invested in. And they're just automatically making these investments for you. There are some robo-advisors. So Vanguard, very respected. Yes, you can have an individual stockbroker. You can also just have a robo-advisor. So when you think about Charles Schwab is another example. So those are two that you're familiar with. Two relatively new companies, which you may or may not have heard of. One is called Betterment. And they don't have, I don't think they have real people. I think it's all robo-advising. And Acorns is another one where they have robo-advising. Okay. The amount there is a lot less. You can get in, with about $500, you can open up a Betterment account or a Vanguard account to start investing. So one example of robo-advising, if you have a 401k or a retirement account, some retirement accounts now say, how old are you? When do you plan to retire? And they go, okay, well, based off of that, you should probably be investing 60% stocks, 40% mutual funds, right? And so that's an example of robo-advising. It's not specific to Erick, right? But it's specific to a man in his 40s with this level of income, with these types of goals, right? And they've just lumped me into this group of people that think similarly, have similar goals and assets that I do, and say, this is what you all should do. The third one to think about is a financial planner or financial coach. Okay? A financial planner or coach, they're a stockbroker, yes, or they help you pick stocks. They may even be able to help you purchase those stocks. But what they're also doing is, more broadly, they're helping you manage your budget, helping you achieve your financial goals, helping you create a financial plan. Told you guys earlier in the semester, there was this amazing woman. Her name is Samantha. She's a financial planner, and she was supposed to come speak to the class, but then she got busy and had to cancel on us. And then I had another gentleman who was supposed to come in in the month of May. His name is Daryl, and he's a financial coach. And so both of them would tell you that it's like absolutely essential that you have a financial planner. And both of them know way more than I do about financial stuff, because this is what they do. This is their life. But I do want you guys to realize this is that you all you've learned how to manage your own budget. You've learned how to achieve your financial goals. You've also learned that it's not that complicated to do. The complicated part is having the discipline to want to do it. And then you all are working on your financial plan. So you're creating your financial plan. So it's about having the discipline. The other thing is about having the time. So at some point you go, you know what? I'd rather just pay for someone like to do this for me so that I can continue to put my time somewhere else. Any questions on this question? Did I answer this question for those of you who had this question? There was a group of you that had this question. All right. Learning more about investing. Okay, if you want to learn more about investing, what? I didn't do enough? Okay. Read books. 2 books that I have read that I found helpful is The Millionaire Next Door. Mila talked about that book as well in her presentation. And also a book by Robert Kiyosaki called Rich Dad, Poor Dad. I thought that was just a phenomenal book. And then I didn't just want to give you my own suggestions. But I just Googled the 10 best investing books of 2020. And so I would just Google great investing books and get some ideas there. I pulled this one out, Thinking Fast and Slow, because I saw this on this list when I looked at it this morning. And y'all, I thought I read this book. I was like, I know I read this book before. And it's interesting. This morning, I was reading another book, and they referenced Thinking Fast and Slow. And I was like, yeah, I read that book before. And so then when I saw it on this list, I was like, man, I read that book. And then I started looking at it, and I was like, I don't think I read that book. So, but I keep hearing about it. So it's going to be, something I'm going to accomplish over the summer is read that book, Thinking Fast and Slow. I feel like I read it. You can take a course specifically on investing. So this course is not specifically about investing. This is more broadly just how do you manage your money, how do you manage your life, and let money be a part of that. But you can take a course specifically on investing. The type of course you take really depends on what your learning goal is. Right? If you want to do day trading, there's a specific course you can take for that. If you want to just focus in on your retirements, then you can take a course that just focuses on that. You can take an accounting course, right, where you're going to learn how to read financial statements, but you're also going to have to, unfortunately, learn how to do debits and credits and adjusting journal entries and depreciation. So it really depends on what the learning goal is. I do have to say this, you have to be careful of those courses that offer get-rich-quick claims, right? Because usually those courses come with all right, now you just have to buy this book or buy this product, and then now you have to sell this product to someone else, right? Starts to look like a pyramid scheme, like a Ponzi scheme. You can play a stock simulator game. So if you go to Investopedia, I don't know if you all heard of that, but it's a great reference point website for financial terms, definition of financial terms. They have a stock simulator. So if you just want to start practicing in terms of picking stocks. The other thing, and again, I talk real bad about Robinhood, but and it's because I don't see Robinhood as a means of investing. I see it as a game, right? And it's somewhat of a fun game, right? So what I'm thinking there is you can take $100, $500, assuming that's not a lot of money to you. And then you can go and open up a Robinhood account and start buying individual stocks. You can buy one stock of Ford, one stock of, what am I invested in that keeps losing money? I think it's JCPenney's or Sears, one of those two, the Cheesecake Factory, right? And then watch it go up. Then you get excited, it goes down. But basically what you're doing is you're also stimulating what would have happened had I invested not $100, but $1,000 or $10,000. And then you can always learn from the internet, YouTube, blogs, Investopedia. Put that one out there as well. I think really, once you decide that you want to learn, you're going to find places to learn. But it's really just about you having that desire to want to learn it, and then finding a way to accomplish that becomes a lot easier. Questions? Is there anything else that you're thinking of that I didn't cover on this slide?
When it comes to Robinhood, do you have to put any of your own money in, or even in Investopedia to like sign up? I just went on there.
So Investopedia, no, you do not. Robinhood, you do, I believe you do have to put money in to invest with Robinhood.
Oh, okay.
So it's a game, but it's going, it's like going to Vegas. It's going to cost you money to play. Other questions? There's a question coming in the chat. Where should we invest our money instead of Robinhood? Well, I don't see Robinhood as an investment. I think you should invest your money in one of those S&P 500 mutual funds to start. And then once you kind of feel comfortable there, or that you have enough money invested there, then you can move into some more robo-advising, where you can get more into stocks and bonds and finding a mixture. But I don't consider Robinhood an investment tool. I consider it a game. So one student, Willie, is still having issues hearing. What about the rest of, how am I doing?
I can hear fine.
Fine.
I can hear you.
Okay. All right. Sorry you're having those issues, Willie. So let's do a little math, because, so we want to figure out how do you calculate your return, your yield when you're investing in stocks. Okay. So the first thing you want to do is find what's the initial cost of investment. So let me tell you guys, I'll tell you a story. I think you all know, by virtue of what's behind me, I'm a Star Wars fan. And back in 2012, October 30th to be exact, Disney announced that they were purchasing Lucasfilms, the right to Star Wars. Right? And so I, being a Star Wars fan, said, oh my God, I must become an owner of Star Wars. Right? So therefore, I'm going to buy some stock in Disney just so I can say I'm an owner of Star Wars. See, to me, this is not investing. This is just wanting to own Star Wars, right? So I went and bought stock, and these are real numbers. Look them up. It was $43.98 when I bought this stock in Disney. This was on October 30th. This is October 31st of 2012. So let's say I decided today, what's today? April 21st of 2020, to sell the stock. Okay. So first thing I want to do is find out what's the total amount of dividends that I've been paid from October of 2012 to April of 2020. Okay. So I looked that up and I was shocked that over this time period, right, and this is for every share that I own, right? Let's just assume I have one share. Okay. They've paid me since December of 2012 to December of 2019, a total of $10.72. So I paid $44 to own it. And then over the 8 years, they've given me about $11 because I'm an owner of Disney. So let's say I decided to sell it today. So when I looked, I don't know what it's trading at right now, but when I looked,
$1.12.25.
I'm gonna go with $111.95 because that's what I saw. What'd you say, 111.12 cents?
It was 112.25.
112.45 cents. Okay. So if I decided to sell at $111.95, okay, today, right, this would be the closing price when I sold it. So I add this number and this number, okay? That gives me $122.67. Okay. So to calculate my yield on this investment, I would take that 122.67, divide it by what I bought it for, $43.98. Okay. And that gives me, if you do the math, 2.7. Now I'm going to subtract 1 from that because that was my cost. So that gives me 1.79. Okay. And what that means is that investment, that silly decision I made in 2012, has yielded 179%. 179%. Remember that 2% we were talking about if you do a mutual fund? I'm not a mutual fund, like a money market fund, or the 1.5% on a CD. 179% over 8 years. Okay. What that means is, like, if I had invested $1,000, 8 years later, I would have $1,000 plus $1,790. So let me see what questions you have.
Tell me again why you subtracted 1. What was the 1? Is that your initial investment?
Yes.
Okay.
I didn't make 279% on the investment. I made 179% on the investment. Now let me show you where I got these. Can I show you where I got these numbers from? Okay. Stop share. Go back to here. So I went to Yahoo Finance. Okay. Can you all see my screen? I think so. And so let's just start here with the summary. Went to Yahoo Finance, looked up Disney, typed in Walt Disney, their ticker symbol, DIS. And then I go to historical data. And here I can change the time period. So the first thing I want to know is, like, when I bought this, first I have to figure out about when I bought it. 10/30/2012. Show me the historical prices from 10/30/2012 to, and I just did 12/31/2012. But you know, so I don't need 8 years of history. So I'm just trying to find a specific date. Done. Click apply. And oh, there we go. 10/31, it was $43.98. So that's a quick way of figuring out what did I pay for this stock when I bought it. You can see here that it's showing also dividends. There were dividends paid on December 6th. That was it that year. But what I can do is if I change this to go from October 30th, 2012 to today, 4/29, say the 29th of 20. Click done. And over here, where instead of saying historical prices, I said, just show me the dividend. Okay, so from this 8-year period, what was in dividends? And click apply. And then it told me that I got 75 cents on this day, 86 cents. This is per share, $1.15 on that day, etc. So I added them all up. I could also have downloaded it and then had Excel added up. So that's how I found that information. Questions? All right, so we are now going to do a class exercise. Yay, woo! So I'm gonna put you guys into 8 breakout rooms, okay? And each room is gonna get a, each room is gonna get a company, okay? So we've got Sprouts Farmers Market, Apple, Centene Corporation, Berkshire Hathaway, Johnson & Johnson, Stitch Fix, Starbucks Corporation, NXP Semiconductors. Okay. So what I want as a group you all to do is answer these questions. Okay. Number one, ticker symbol. Number two, if you had purchased stocks on March 31st, 2019, 50 shares, this stock on March 31st, 2019, how much would you have gained or lost as of today? April 20, today's the 29th, right? April 29th. And then if you had purchased 50 shares on March 31st, 2018, right? And then you sold it today, how much would you have gained or lost? Okay. How much dividends would you have received over the past year? So go from March 2019 to today. How much would you have received over the past 2 years, March 2018 to today? And then calculate the total return for years 1 and 2. So you all should take a picture of that. Because I'm going to put you in the breakout room, and if you think someone else is going to in your room is going to take a picture, they're probably not. So you should take the picture. So you have the questions, and then you'll know what group you have, okay, or what company you have. If you have questions, you can your group can invite me into the room, and then I can go in and we can talk about it. If you are already invested in Centene Corporation and you're like, I really want to be in room number 3. By the way, I'm not even sure what Centene Corporation does. Just let me know and I'll move you to a different room. Like you really want to be in a specific room. All right, so you all should have been invited to your rooms, and you can go in there and get after it. So Versavia, Benpreet, I don't know who the E is, and Jalen, you all should be able to go into your breakout rooms. Let me know if you don't see it. Can you re-invite me? I didn't see the company names. Number 5. Johnson & Johnson. So I'm going to put you back into 5. I think that's what you're asking. Oh, you're already in 5. Johnson & Johnson. Jalen. So there should be a button for you to click somewhere to join. And Benpreet, you should be in breakout room number 1. Benpreet, I'm actually going to move you to group 3.